Okay, so we have a question over here. Presented below is the selected information related to Flanagan Company at December 31st, 2017. Flanagan reports financial information monthly. We have equipments of $10,000. Equipment is our non-current asset. Cash is $8,000. This is also our non-current asset. Service revenue. Revenue is sales. That's the part of income statement we have just discussed right at the start of the our class. Rent expense. Expenses is also part of income statement. Accounts payable, that's liability, current liability, utilities expenses, income statement. Accounts receivable, that's our current asset. Salaries and wage expense, that is expenses which will be recorded as operating expense. Notes payable, that's liability. Owner's drawing, which will be part of equity or capital. In the first part, it tells us to determine the total assets of Flanagan Company at December 31st, 2017. So total asset is basically sum of non-current assets and current assets. We have total assets. The total assets are 10,000. Equipment,
Why
that's the
isn't
non-current asset. Yes.
why aren't rent expense and utilities expense assets?
Utilities expense are not assets. They are not assets. You can even see the solution. Is it visible?
Yes.
The assets are equipment, $10,000. Cash, $8,000. That's the current asset. Okay. And accounts receivable. Accounts receivable is our current assets as we have sold the goods on credit basis, but we haven't received money from our credit customers. That's the current asset. Cash, accounts receivable, and equipment. We will add it in order to get the final value of total assets. 8,000 plus 9,000 plus 10,000. Total assets will be 27,000. Is it clear?
Yes.
Expenses are not assets. Expenses are part of income statement. If there is any query, if you don't understand this, you can ask me right.
It's fine.
Okay. Now let's move on to part B. Part B says determine the net income that Flanagan Company reported for December 2017. So in order to determine the net income, we will have to prepare the income statement. Here is the solution for the income statement. We had just discussed it in our last class. Income statement starts from sales or revenue. Sales are 36,000. It's written over here. I can even mark it for you so that it's become visible. Service revenue 36,000.
There is
Service
no
revenue.
opening and closing inventory.
No, there is no inventory, so I will assume that there is no cost of goods sold as there are no costs related to inventory. So we will just start from, which means there will be no gross profit. So we will directly start from expenses. Does this make sense?
Yes.
In expenses, first of all, we have rent expense, which is 11,000. Then we have salaries and wages, which is 7,000. Then we have utilities expenses, which is 4,000. We will add all of these expenses in order to get the total expense. Then we will subtract revenue from expenses in order to get profit for the year or the net profit or net income. Does this make sense?
Yes.
Now you can copy.
I copied it.
Great. Now we know what are assets, what is capital. We know how do we prepare income statement. We know the nature of asset, liabilities, equity, capital. Now we are familiar with this. Let's move. I'll clear the screen. See, here is the format for income statement. Sales. If there is no cost of goods sold, we will not record cost of goods sold. We will directly start from expenses. Sales minus expenses equals net income or profit for the year. Okay. Now let's discuss the accounting equation. Accounting equation is capital equals to asset minus liabilities. Capital equals to asset minus liabilities.
Okay.
You should write it. Capital equals to asset minus liabilities. Or if we make asset the subject, then it is going to be asset equals to liabilities plus capital. Is this clear? Does this make sense?
Yes.
So what am I trying to tell is that capital equals asset minus liabilities. I can even rewrite this as asset equals to capital plus liability because the liabilities will go on the left hand side, so the sign will change. Or I can even say liabilities equals to asset minus capital.
Okay.
These are, this is basically accounting equation.
Okay.
This relationship is the basic accounting equation. Assets must equal the sum of liabilities and owners' equity. अब assets क्या होता है? We have already discussed this. Assets are basically what is ownership of a business, what the business owns. Assets helps generate profits. The business use its assets in carrying out such activities as production and sales. The common characteristics possessed by all assets is the capacity to provide future service, future benefit. For example, consider Campus Pizza, a local restaurant. It owns a delivery truck that provides economic benefits from delivering pizzas. Other assets of campus trucks are tables, chairs, jukebox, cash register, oven, tableware, and of course cash. Assets में आपको पता we have two categories. One is non-current asset, which have a life more than a year, and the other one is current asset, which have a life less than a year. Non-current assets includes building, motor vehicle, and current assets include inventory, trade receivables, cash in hand, cash at bank. These are all current assets.
Oh,
Liabilities are claims. Gee, if you are asking something.
no, I just said okay.
Liabilities are claims against assets. These are legal bindings. These are legal obligations that we are supposed to pay. Okay? When a business borrows money or purchases goods on credit basis. See, I told you, right? Okay, goods can be purchased on two bases. It can either be purchased on cash basis or it can either be purchased on credit. If the business purchases it on cash basis, then it will be recorded as cash purchase. If the business purchases it on credit basis, which means that the business will pay in future for inventory, let's suppose. So that will be credit purchase. And this will be part of accounts payable. Notes payable are long-term loan. Salaries and wages payable to employees, and sales and real estate taxes payable to local government. These are all part of liabilities as business owes. These are owing expenses. They are all part of liabilities. For example, business campus pizza owes money to its creditors. Creditors may legally force liquidation of a business that does not pay its debt. In that case, the law requires that creditor claims be paid before ownership claims. Owner equity is also known as capital. Capital is equal to asset minus liabilities. Assets of the business are claimed by either creditors or owner. To find out what belongs to owner, we subtract the creditor claims from the asset. When we subtract creditor claims from the asset, we get the final value of owner's equity or capital. Does this make sense?
Yes.
So, what are the factors which could increase owner's equity, which could increase capital? Number one, we have is investment done by the owner. If the owner invests his personal assets or cash into the business, that will be part of that will increase owner's equity. Then we have revenue. Revenue are gross increase in owner's equity resulting from business activities entered into for the purpose of earning income. Because if revenue increases, profit for the year will go up and eventually owner's capital will also rise. The formula for capital is capital at start, add net profit minus drawing is equals to capital at end.
Okay.
What are the factors which could decrease owner's equity? Number one we have is drawings. When the owner withdraw cash or other assets for personal use. If I withdraw cash, if I withdraw any asset for my personal use, for my own use, that will be part of drawing. And the drawings are going to decrease owner's equity. They
Okay.
will decrease owner's equity. Then we have expenses. Expenses are cost of assets consumed or services used in the production of earning revenue. Higher expenses will lead to lower profits, and eventually lower profit will result in lower lowering capital or owner's equity.
Okay.
Okay? So these are the factors. Equity increases if the owner does investment of an asset or puts his cash into the business. अच्छा capital के अंदर भी we have two major categories. One is known as startup capital that is used to start a business. When we are starting a particular business, we use startup capital. The other one we have is working capital. Working capital is the money required to pay for day-to-day running expenses of the business. You can write it. Working capital is the money required to pay for day-to-day running expenses of the business.
Working capital.
Yes, working capital is the money required to pay for day-to-day running expenses of the business. Is the money required to pay for day-to-day running expenses of the business. The formula for working capital is current assets minus current liabilities.
What was the formula?
Current asset minus current liabilities. You know, right? What are current assets? What are current liabilities?
Yes.
Should I repeat it?
No, I know.
Okay. ठीक है. Can you solve exercise number 3 from this book? You just have to classify them, that whether they are part of expense, whether they are part of drawings, either they are part of revenue or they are part of equity. Just have to classify them.
These four.
Yes, rent expense, service revenue, drawings, and salaries.
Rent and salaries and wages are expenses.
Okay,
Services are revenue and drawings is owners. Right.
is owner's drawing. Okay, drawing is owner's drawing.
Okay.
Now let's discuss this. Transaction, investment by the owner. Ray Neal starts a smartphone app development company, which he names SoftBite, on September 1st, 2007. He invests $15,000 cash into the business. This transaction results in an equal increase in assets and owner's equity. As he is investing, this is a startup capital. This is the money required. This is the investment done by the owner. So it is done in the form of cash. Cash is our asset. Asset will increase by 15,000 and capital will also increase by 15,000. Why the capital is increasing by 15,000? Because this is an initial investment. He had done an investment in the form of cash. So assets will also increase by 15,000 and owner equity, also known as capital, will also increase by 15,000 as this is initial investment. And initial investment has been done in the form of cash. Does this make sense?
Yes.
Now let's discuss transaction number two. SoftBite purchases computer equipment for $7,000 cash. This transaction results in an equal increase and decrease in total assets, though the composition of assets changes. अब वो कह रहे SoftBite purchases computer equipment for $7,000 cash. Cash is decreasing by 7,000 and computer equipment is increasing by 7,000. This means that both one asset is increasing and the other asset is decreasing. Cash is decreasing by 7,000 and equipment is increasing by 7,000.
Okay.
But there will be no effect on the owner's equity as this is not done for investment as he has purchased computer equipment for 7,000. We haven't done any investment. This is not an investment. The business has purchased computer equipment for $7,000. Does this make sense?
Yes.
So the owner's equity still remains at 15,000. There will be no effect on owner's equity as the
Oh,
business itself has purchased the computer equipment via the cash of the business. This is not done by the owner from his personal account. Now let's move on to the next one. The asset supplies increases $1,600 and the liabilities account transaction number three. SoftBite purchases for $1,600 from mobile solution assets and other computer accessories expected to last several months. Mobile solution agrees to allow SoftBite to pay the bill in a this transaction is a purchase on account. Asset increases because of expected future benefit of using headset and computer accessories. Liabilities increases by the amount of mobile solution. So uh, basically, they will pay the bill in October. So over here, they are talking about liabilities. The supplies The inventory is basically our asset, current asset. So supplies will increase by 1600, but the owner will pay the amount at a future date. Owner will pay the amount in October. Clearly states over here. This transaction is a purchase on account, a credit purchase. The owner has purchased goods on credit basis. We will pay the amount at a future date. Okay?
Okay.
Asset will increase because the supplies will provide some future benefit, definitely. But on the other hand, liabilities will also increase as we will have to pay $1,600 in a future date. Does this make sense?
Yes.
So cash will remain same as 8,000, but supplies will increase by 1,600. Equipment will also remain same as 7,000. Total total assets are going to be 16,600. Liabilities. Liabilities will increase by 1,600, but owner's capital will remain the same. There will be no effect on the owner's capital as the transaction has been done by the business. This is a credit transaction which has been done by the business. Over here, it's not talking about investment. It's not talking about any startup capital. So owner's capital or owner equity will remain the same. You can clearly see over here that asset equals to liabilities plus capital. 16,600 is equals to 16,600. So if it fulfills the requirement of the accounting equation, this means that we have done this question actually. Does this make sense?
Yes.